Hello, Andrew here. Welcome to my channel on investing. ETFs are diversified baskets of securities, so I shouldn't really trouble myself too much with researching them. And that is what I thought at the very beginning. But it doesn't mean there are no pitfalls to investing in ETFs. I myself made and paid for my mistakes by overlooking many stumbling blocks. Here are my top 5 mistakes to avoid when dealing with exchange-traded funds. Also, stick to the very end. There I will go over one resource or some helpful article that I discovered that helps me personally to further my investing education and knowledge. The first mistake I made early on was not having clear goals for investing in ETFs. There are 3 very basic questions I should have asked myself at the very beginning. The first is about investment horizon. If my investment horizon was long at the very beginning, I should have gone with mostly equity holdings. But if my investment horizon was short, then capital preservation is all I would care about. So things like bonds or maybe dividend stocks, ETFs, would be something I would consider. The second question I should have asked myself is, how risk tolerant am I? I don't know about you, but I'm personally okay with taking moderate amount of risk. But even so, it's one thing to answer this question hypothetically, and it's a completely different matter when you actually experience market drawdowns firsthand, and only then you discover what's your real risk tolerance. And this is exactly what happened to me after I experienced my first real bear market and I understood better my psychology.
And finally, I should have asked myself this: how soon do I need money I'm about to invest? This question is somewhat related to the investment horizon. If, let's say, I needed money in a year to buy a car, putting all my funds in stock ETFs would not be a good idea. Something more stable and less riskier would make sense, like a short-term treasury fund.
Knowing my investment goal sounds very fundamental, but it goes a very long way. I made a habit of asking myself these 3 questions and answering them every year, and if nothing changes, then all is good, but if otherwise, I would change my portfolio accordingly. The second mistake I made was being lazy about researching ETFs. In fact, many more problems stem from this one. Before, I was guilty of just seeing or hearing about some ETF, reading its one-line description, and off I go. And this was a very lazy approach that beat me back many times later.
Let me give you a very quick example. Take a well-known Vanguard Information Technology Index fund, or VGT. The fund is great, but it's extremely top-heavy. Microsoft, Apple, and Nvidia account for a whopping 44%. There's nothing wrong with this concentration if I understand where these 3 stocks are heading. Otherwise, investing in VGT entails risks I do not fully understand. What's more, only looking at top holdings usually does not cut it, at least for me. As a rule, I must know how an ETF constructs its portfolio. For instance, take the popular Schwab Dividend ETF, SCHD. The fund tracks the Dow Jones US Dividend 100 Index. Okay, cool, but do I know what this index does and all the nitty-gritty of its selection process? The thing is that indices are no more than a set of rules, screens, and filters that condense a universe of securities to an investable portfolio. But these rules have a profound effect on future performance. For instance, due to its strict selection, SCHD has a much heavier tilt towards value stocks with an above-average yields. This has a big effect on SCHD's performance long term.
The same logic applies to leveraged ETFs. I made a video where I took a deep dive into these ETFs. These leveraged ETFs are great until they're not. I would say that since learning about this mistake, I research ETFs I want to invest in great detail. Doing so allows me to stay level-headed during the time of turbulence. And as a bonus, I'm less likely to panic sell my investments. The third pitfall I try to stay away from is ending up with a hodgepodge portfolio of ETFs. An example of this is some weird-looking portfolio of some randomly selected ETFs. For example, today my brother tells me, "Oh, this AI ETF will outperform anything on earth." Well, I must buy it. Tomorrow someone says, oh, the meme investing is the hot new thing. I must buy it too. There was actually an ETF tracking meme stocks with the same meme name by Roundhill. It never took off and was shut down in 2023. More recently, I made a video about AI ETFs. There I took a deep dive into AI theme and how to invest in it with ETFs. If you watch that video, by the end you will learn that it's not even clear if these so-called AI ETFs provide a good exposure to this theme. But it doesn't have to be anything exotic. Even seemingly harmless ETFs such as small caps or growth, if added to any portfolio without any thought, can spell trouble. What's more, similar funds can overlap in their holdings and worsen your diversification if that's a goal.
For instance, VGT and QQQ are two outstanding growth ETFs, but they have a 48% exposure overlap. That's a lot. The result is a highly correlated return between the two. For someone, it's okay, but for me, it's a problem.
So it's easy to fall into this trap and end up with a zombie portfolio with subpar returns. So sometimes it's even better to stick with something simple. Even a 60-40 portfolio ETF can work wonders for some people. The fourth mistake I made early on was not having a regular investment plan. Sometimes things would get in the way and I would just forget to transfer and invest money. What I found easier with time is to have a broker that offers automatic investment plans. So you can not only set up recurring deposits, but also have automatic investment plans for those money that you transfer. Also, another reason that prevented me from investing regularly was my concern with where markets are going. Basically, it's about timing markets. As I quickly discovered, that's the worst idea. There's no knowing where markets are going tomorrow, in 2 years, or even 10 years. The best that we can do is to know that markets historically did pretty well long term. And so we can just assume that and invest based on that assumption. And sometimes dollar averaging is the way to go, as it will help you take off that emotional burden of trying to time markets by yourself. And the last mistake has to do with emotional endurance. I heard many times how I must invest for the long term and ignore a bear market. But that's easier said than done.
I don't know about you, but when I see my multi-year unrealized gains evaporating in a matter of weeks, I start to worry. Selling during a downturn was probably my worst mistake in my early years of investing. Doing so, I gave up on a chance for recovery and locked in losses.
But what can we do about this? I think knowing about things that you invest in helps a lot. For example, if I know that my core holdings are in S&P 500 or a 60-40 portfolio ETF, for instance, I think I know that things will be fine. I mean, if they are not fine for S&P 500, then forget about the rest of the stock market.
And guys, as promised, here's what I found useful this week. It's a newsletter by Matt Levine called Money Stuff. The newsletter is free and available from Bloomberg. Matt is a former lawyer and investment banker. You may have heard about him. The newsletter comes out every weekday. The reason I love it is not only for the deadpan witty style of Matt, but also his invaluable insights on things happening today on Wall Street. He covers security frauds, special situations, and other economic happenings. Very cool stuff.
So these are my top 5 mistakes. Do you have of your own mistakes to add to this list? Let me know in the comments. I hope this video will help you identify areas in your portfolio that you can improve on. And please give this video a like and subscribe to my channel for more content on investing. Thank you for watching.